What's up, guys? My name is Richard. Today, I wanted to share the two best bull market yield farming strategies that I've found. And when I say bull market, I mean that when the prices are cheap, like it is right now, and you still expect the prices to increase in the next 6 to 12 months. And I'll break down the pros and cons with each strategy and a few tips that would help you execute those strategies successfully. So this is my open position. The first strategy that we're going to talk about is the crypto to crypto pools. So with this strategy, I'm trying to accumulate more crypto, either the assets that I'm providing liquidity for example, Sol to Ethereum, Pixel to ETH, Bonk to ETH, or my goal is to stack the quote asset. In a lot of cases, it's Ethereum for me. You could use Sol as your quote asset if you're providing liquidity for stuff like Radium and Sol, or even Bitcoin if you're providing liquidity for Bitcoin pairs like ETH and Bitcoin. And you can see the APR is pretty decent for a blue chip pool like Sol to ETH, especially when I have such a wide range here at 0.025 and 0.099 on the top range. So let's dive right into the pros and cons of crypto to crypto pools. So the first pro is you're probably going to have a higher APR even with wider ranges. You could see Sol to ETH, roughly 21% APR. But if you look at like smaller cap tokens, you could see 83, 37% APR. Bonk to ETH, 106%. ETH to Arrow, 31. 75% here. And this position, I'm still trying to turn around, but if it's in range, the APR is pretty decent. And if we click into this Pixel and ETH pool here, my bottom range is roughly like 40% down from this current price, and my upper range is almost like a 20x from this current price. So quite a wide range, but you can see my APR is still at like 83%. If I'm running like a crypto to stable pool, for example, on Ethereum and USDC, with such a wide range, I would probably get only maybe 10 to 15% APR. And the next pro is a higher upside when the market pumps. Since you're pairing crypto to crypto, you have full market exposure, right? These two assets, for example, Sol to Ethereum, or any altcoins, they're typically very volatile. So when they both increase in price, like your pool value in terms of US dollar is going to increase in price. For example, if Solana and Ethereum both like 2x from now, my pooled US dollar asset would roughly also 2x from this current price. So in a bull market, if I believe that Ethereum is going to retest or like break through its high again, then it makes sense for me to be in this pool and keep accumulating Ethereum and Solana. Versus if you have like a wide range Ethereum and USDC pool, for example, let's say the orange lines are the top and bottom range, right? And you enter right now at roughly 1835. You're pairing some stable coins with Ethereum. And even if you do a one-sided one with mostly Ethereum, what happens is if Ethereum pumps in price, then your Ethereum is going to be slowly converted to USDC. And because of that, your pool value in US dollar term is not gonna rise as fast as a crypto to crypto pool. So you're gonna benefit from a lot of asset appreciation if you're running a lot of crypto to crypto pools right now, as I am. And lastly, it's also higher yield on cost when you do this. And when I mean yield on cost is it's the APR on the initial investment that you put in. So for example, in this Bonk and ETH pool here, you could see I put in roughly 5.367 ETH, and now this pool is worth roughly 6.778. But the APR revert calculates is the fees you earn divided by this Ethereum value that you initially deposited. And if I compound more fees, then it divides to the total amount that you deposited. So it's a yield on cost. I'm not earning 100% on this current asset. I'm earning 100% on my initial investment. If we compare it to a tracker like Metrics Finance Pro, you could see ETH Bonk here. It's only 82, 83% APR on my current capital, because my current capital appreciates while the initial capital I put in stayed the same, right? So since the APR is pretty good in this pool and I entered way down here at this green line, it's probably best for me to basically stay in this pool rather than chase a bunch of different pools. And I could basically sell my fees, all of it, for a profit whenever it's trading above here. Because if you don't already know, if it's trading above your entry, you're going to be at an ETH profit if you're looking at this ETH chart. And that's only counting the initial liquidity, right? Not even counting the fees that you earn while you're in this pool. So if you got a really good entry on assets that you are bullish on, then as the token outperforms Ethereum, your yield on cost is going to keep rising. So that's the major benefits of these crypto to crypto pools. But with any strategy, there are downsides to it. And that's what we're going to talk about now. So the cons is they're going to have a bigger drawdown in terms of US dollar value. If you look at this ETH and Pixel pool that I rebalance into, it's down roughly $14,000 in terms of US dollar. But if we measure it on the ETH term, you can see it's down only 0.5 Ethereum. So why is that the case? Is because when I deposit these tokens in January, the US dollar value of both Pixel and ETH was trading much higher than it is right now. So you're going to see a huge drawdown in terms of US dollar. But really, when you're providing liquidity with like an altcoin paired with ETH, you should be measuring your progress in terms of Ethereum. Of course, in hindsight, it was a better play to just stable up all of my token before the dump in January. But the market is pretty unpredictable, right? In January, if I wasn't going to sell Pixel and Ethereum at that price, then it doesn't matter if there's like US dollar loss on paper, but I'm still stacking both Pixel and Ethereum, right? And you can see it's outperforming just holding in the market. And the next major con I want to talk about is it's pretty high risk, and especially the low cap and new tokens. The newer it is, there's less holders, less buyers, and less price action to trade from. And the lower the market cap, the riskier it is usually. So my pools have been doing pretty well overall for the last couple of months, except for this higher risk play that I went a little bit too heavy on. It's a very new and low cap token, and I think my total loss is sitting roughly at 3 Ethereum right now. You can see the chart, it looks pretty bad. The market cap right now is like $1.4 million. And to be honest, I probably don't want to add more capital to this token. I'm just going to hold on my position and see if this is going to recover. If not, then that's fine. My max downside is limited to whatever liquidity I have left here. So the lower the market cap, especially meme coins, the riskier it is, especially if there's like no other fundamentals behind it except that people are speculating on it. But if we're talking about stuff like Bonk and ETH or Sol and ETH, then these are considered like a much lower risk pool to get into. So that's the main like drawback with these pools, and there are ways to kind of like limit your downside. For example, when the market is overheated and you're running these crypto to crypto pools, you could, for example, short the assets in the pool, right? Like if Ethereum is trading at $6,000, Solana is trading at $300-$400, I'm still providing liquidity for those two tokens, but I expect a pullback, then I could start scaling into some shorts to kind of hedge the US dollar downside. But you gotta be careful with these pools because the asset amount in it changes all the time, and it only makes sense to do it when the market is more overheated. And to de-risk also, you could sell the fees into majors and stables to make sure that you're securing some profits along the way. So a lot of times I'm not going to be compounding all of my fees into these pools, especially stuff like Bonk and ETH when it's like way above my entry. I basically claimed like the fees a few days ago, roughly worth like $390, and then I swapped those fees into Bitcoin. And that basically like lowers my risk as long as, I keep earning fees. I keep swapping my fees into like Ethereum, Solana, Bitcoin, or even into stable coins, right? So those are the pros and cons for the crypto to crypto pools. And I want to give you guys a few tips that have helped me with these crypto to crypto pools. And just as a side note, These are not financial advice. These are just the tips that have helped me and the strategies that have helped me in the past. So do these strategies at your own risk and make sure you do your own simulation, your own research. And my market outlook might be different from yours, right? I can't guarantee how the market is going to move, which is why I never want to guarantee profits. What I can guarantee you is that you're going to be at a higher chance of succeeding if you implement these strategies. So the first tip I have for you guys today is to diversify your positions. And I typically want to aim for 5 to 10 positions in a portfolio because a lot of times like one position goes down and the other positions go up, and then it like kind of like balance each other up. And the nice thing about having a diversified portfolio is, let's say one position is down, but the other one is up and printing a lot of fees. If you still believe in this down asset, then you could use the fees from the asset that is going up to compound into these positions that are at a cheaper price. What this does, it drags down your entry, right? And it's going to make it easier to be profitable. And that's exactly what I did with MOG. That's why it's sitting in divergence loss profit right now. And another reason to diversify your pools is because if one token is not doing well and goes like 90% down, 99% down, you're actually going to lose the whole asset that is in there. Because when it exits the bottom range, for example, in this Bonk and ETH pool, I'm going to be fully into Bonk. And if Bonk continues to decline by like 99%, then my liquidity is going to be basically down by 99% as well. So a lot of people make the mistake of thinking, let's say I have this amount of Bonk, right? Roughly worth 2.65 ETH. And then they look at, okay, I have like this amount of ETH left. So my portfolio is only exposed to this small amount of Bonk. But in reality, you're exposing this whole 6.78 ETH to both Bonk and ETH, right? If one token doesn't do well, including Ethereum, goes to zero, then this whole liquidity would go to zero. That's why you need to diversify your yield farming. And if you guys run like a wide range strategy like I am, then having 5 to 10 position is not going to be too hard to manage, right? I only take like 1 to 2 hours per week to manage these 5 to 10 positions. Of course, you need to have systems in place to do that. Otherwise, it's probably going to take you a bit longer than me. And the next thing you want to do, you want to bet on strong tokens. So when I say strong token is that it's going to outperform at least Ethereum, or at least it's going to like oscillate between underperformance and outperformance, right? You can see like, this space is for everyone pool is pretty weak compared to Ethereum right now. Maybe it'll turn around, maybe it will not. But when you're providing liquidity for a pool like this, your Ethereum value is just going to bleed out over time. If we hop to the Bonk and ETH chart, you can see Bonk basically oscillates between like outperformance here on top and then underperforms, outperforms, underperforms, outperforms, underperforms. So a lot of solid alts typically do this against Ethereum, or it might be like a more aggressive uptrend against Ethereum like Solana is. But in either scenario, you want to make sure that it's trading pretty strong against your core asset, whether it's Solana or, Ethereum, Bitcoin, whichever you're providing liquidity for. Like if I want to invest in Radium, for example, then I want to pull up the Radium chart and then basically compare it against Solana. So if you started here, then your bag would obviously bleed in terms of Solana. But if you entered way down here, you're probably still in Solana profit if you're in this pool. And really, it doesn't make sense to basically invest in smaller cap altcoins if it's going to like underperform the major assets, right? The only reason why you want to invest in smaller cap altcoins is you believe is going to, outperform and allow you to basically gain a higher yield as well as stack whichever core asset you're stacking. And the third is to remember that you're exposed to the worst performing asset. We kind of touched on this on the diversify portion already, but basically, if you're providing liquidity for ETH and Solana, in the long term, if it pumps or dumps out of range, you're basically stuck with the worst performing asset. Hopefully the fees cover that, but also the chart would break in the direction that you want. In the case of Bonk and ETH, for example, I'm totally fine with Bonk, breaking up to the upside because I invested Ethereum and I'm fine with Bonk outperforming Ethereum. It just means that my Bonk is being slowly converted to more and more Ethereum. So in the long run, I would be at a net Ethereum profit. But again, you gotta be fine with the pool going either direction when you're providing liquidity. If Bonk dumps on the downside, then you wanna make sure you believe in Bonk and you believe that the prices are going to recover. And the fourth is you want to make sure you have majors pool. So in my case, I have sold to Ethereum. I have clients that are providing liquidity for stuff like Bitcoin and Ethereum. I also added like a Bitcoin to Sol pool last month, but it's on Solana. And basically this is like the safer play you want to have. The reason why you want to have that is because a lot of these smaller cap altcoins could be unpredictable at times. And this basically gives you more stability and safety in your portfolio. Because Pixel, even though it has provided me with a lot of profit during the last year or so, is still considered a high risk token compared to, Solana, Bitcoin, BNB, or Ethereum. And the last thing is you want to always think about de-risking. So when I'm in this pool, for example, Bonk and ETH, when it's trading above my entry, I'm always thinking about de-risking, okay? Am I going to compound my fees or am I going to de-risk my fees and sell it into something safer like Bitcoin or Ethereum or Solana? Because I don't want to be in a position where basically I retrace all of my gains. So you got to make sure you're always thinking about taking profits, especially when the prices are trading above your entry. So that's the first strategy. And this video has been running a bit longer, but hopefully it'll be worth your time. So the second strategy is a leverage bull strategy. What we're going to do is we're going to have lending and borrowing on platforms like Aave. We're going to lend out assets like Ethereum, Bitcoin, Solana. Then I'm going to borrow a stablecoin, either USDC, USDT, DAI, whichever one that's available and that you believe in. So borrow, and then I'm going to use that asset to provide liquidity in an LP. So in this LP, you could do a crypto to stable pool for a lower risk LP, or you could do a crypto to crypto pool. So this is stuff like, for example, ETH to USDC, or if you're lending a lot of Solana, then it's probably a good idea to provide liquidity for Sol to USDC. And crypto to crypto pool is the stuff that we just looked at, right? ETH to Sol or Sol to BTC. So these are going to generate fees, right? Then I could use those fees to pay back my leverage if I want to deleverage. Or if I want to borrow more, then I'm gonna buy more crypto and then basically borrow more against that and keep looping that. So that's a pretty simple roadmap. You could screenshot this or save this if you like. And let's just run through an example number here. Let's say you have $10,000 worth of ETH, Bitcoin, Sol. You borrow $4,000, for example, and then I'm going to use that $4,000 to put it in an ETH and USDC, for example, if I'm lending out a lot of ETH. And you want to make sure that it's a good chance that we're going to keep trending up, right? Because if you enter into an ETH and USDC pool, similar to like the crypto to crypto pool, whenever it's trading above your entry, for example, if you enter right now, your initial liquidity, that $4,000 is going to be at a US dollar profit when that happens. But if it dips below, then you're going to be at a US dollar loss because you're buying more Ethereum, and that's decreasing in price, right? Just to keep that in mind. So you definitely don't want to execute the strategy, especially at like key resistance levels here. Let's say you're taking out a lot of loan when Ethereum is at like $3,500, $4,000 to yield farm with that. then it's going to be, very easy to be liquidated when this value dumps. Because if we dump to, let's say, $5,000, if Ethereum drops by 50%, right? My original LTV or loan to value ratio is only 40%, right? 4,000 divided by 10,000, that's 40%. But now if my asset in the lending side drops to $5,000, that's 4,000 divided by 5,000. That's an 80% LTV, which is very high. And some platforms liquidates you at like 75% or 85%, depending on which asset you're holding. And that could be bad, right? Because liquidation often comes with fees. And then, you have to worry a lot about your positions. If you want to run this, I would still run wider pools if you want lower risk. Because if, let's say, ETH and USDC, you put in $4,000 into this pool, right? And let's say this pool dumps to like $2,000 in US dollar value when this ETH, Bitcoin, and Sol drops to 5,000. In reality, it would be less because you're pairing, USDC in this pool, right? So your drawdown should be less than $2,000. But let's just say it exits your range and you're stuck with $2,000. Instead of letting your position be liquidated, what you want to do is you want to withdraw whatever liquidity you have left here and then stick it back to the lending side. Let's do the math on that. Let's say you have $2,000 left over. It's going to be $4,000 left to repay if you're not repaying anything back, right? Divided by $7,000. Your LTV is only 58% in a big market dump, rather than if you just, kept this $2,000 liquidity inside the pool. So that's the basics of it. You want to work out the LTV beforehand and your liquidation point, because you got to be prepared for like all scenarios, right? And you could definitely be more delta neutral as well, depending on what you set the range for the USDC and how you actually go about, executing this, right? But let's look at the pros and cons. The first advantage is there's no impermanent loss on the lent asset. Basically, whatever I lent, Ethereum, Bitcoin, Solana, is not being like slowly converted to USDC when compared to like a crypto to stable pool, right? So there's zero impermanent loss on that. There's only some impermanent loss on whatever assets you're providing liquidity for. And this is exactly what we want when the prices go up, because if I have this $10,000 here, the price is 2x, I'm not going to be converted to USDC. This is going to turn to like 20K. And when that happens, the ETH to USDC pool is going to appreciate in value as well, not even counting the fees, and I could easily pay back that $4,000 loan. The second is there's more asset appreciation, similar to the first point, because you're not exposed to impermanent loss, right? And the third is it's lower risk if you stick with majors. Because a lot of crypto to crypto pools, if you're aiming for a higher yield, you have to go with lower cap altcoins. But with this strategy, you could basically stick with Bitcoin, Ethereum, Solana, BNB. There's much less risk on the underlying assets. The cons is it's typically less APR if you're doing it safely. I personally, again, like wider ranges, even if I'm doing this strategy. It might be a little bit tighter than what I would normally run without this strategy, but I still run a pretty wide range. And the important part is if you're doing this leverage strategy, you probably want to keep your LTV at like 30 to 50%. And because of that, you're only yield farming with like 30 to 50% of your capital, right? So there's going to be a less net APR on your overall portfolio. So that's a trade-off, but definitely a trade-off I would take if I'm not running crypto to crypto pools, if I believe that the bull market is intact and it's going to go up in the long run. Another downside is there's more smart contract risk, because now you're providing liquidity in a liquidity pool like Uniswap, but you're also exposed to lending protocols like Compound or Aave that you're lending and borrowing from. And lastly, there's liquidation risk if the market dumps very hard and you haven't de-risked at all. then you're at a much higher chance of being liquidated. Leverage cuts both ways, right? It could increase your gains, but it could also make the losses much more. And just to wrap this up here, let me give you guys a few tips to run the strategy. You want to maintain a healthy LTV, roughly 30 to 50%. Typically, when you first start out, maybe 40%, but you definitely don't want to go over 50% in most cases. If you prefer lower risk strategies, then you still want to run wide ranges on your pools because the price fluctuations is not going to matter as much. So for like crypto to stable pools like Ethereum and USDC, if you're running wider ranges when prices dump, your liquidity pool value is not going to decrease as much. And during pumps, you're going to stay in range for longer to collect those fees, and your asset is going to appreciate more compared to a tighter range strategy. And the third is I would still personally diversify with other liquidity pools, like other crypto to crypto pools, assuming that you want more market exposure. And the fourth is you want to pay back your loans with the fees and profits, because this is going to decrease the risk. And the last thing I would consider is having a spare liquidity to back the loan. So let's say in this example, right, if there's like $10,000 of lent assets, you're borrowing $4,000. If this dumps to like $5,000, but you have a spare $1,000 to $2,000 to add to this, then it's going to keep the health of the LTV much better, and you're at a much lower risk of liquidation. So I hope that helps, guys. And I'm pretty transparent with which tokens I'm providing liquidity for. Like for example, this April portfolio update. You could look at the older ones too in March. I'll probably do this like once a month. And if you haven't already, click that subscribe button and be sure to turn on the notifications if you want to be notified when I release a new video. Thank you once again for watching. I'll catch you guys next time.